Let's look at a strategy called calendar spread. Meta has earnings reporting this week. So we see these options here expiring in 2 days. 2 quick days. It's currently trading at 748. The market makers have a $48 move priced in. Let's go to the calls. The ones that expire in 2 days, that's exactly over $50 out the money, are $8.35. So that's $8 of pure time value. So the way a calendar spread works, you got to have two legs, a long month and a short month. So since these expire in 2 days, you couldn't use this one for the long. You would go out to the next, November 7th. Now, let's look here. We can look at the 810 calls, and we will buy one, $9.20. That's pretty expensive for a call that's over almost 10% out the money. You know, you need a 10% move plus to actually have intrinsic value, and you only got less than 2 weeks for this to expire. But because options, they made up from volatility price, the implied volatility on this is so much higher because they report earnings this week. So if we go to the ones that expire just in only 2 days, you see this one, we can sell $6.35. So we get into this trade for $2. And I'm going to pay up because I want to show you the next phase here. Let's see if we get filled. See if we pay up a little bit. Robinhood doesn't have the highest order filling capacity, but it's not that big of a spread. Now, it costs $275 to get into this position as opposed to $800 flat out. And let's look at the metrics of this calendar spread. So the break-even price is $722 to $920. So let's simulate the returns. Right now, and I believe they report tomorrow. Expiration day is tomorrow. So let's say tomorrow morning. Let's say 8:30 a.m. If Facebook doesn't move at all, just fakes out up, down, and they just open flat, this option calendar spread to be up $410 because you're selling time. If we somehow go up, though, you still can capture considerable gains all the way to end the money. If it just gaps up and just blows earnings out 10%, you can go up. Now it's going to get capped at about right where your strike plus whatever premium you paid is, and then start going down. But it'll have to go down. It'll have to go up like 100% for you to actually lose money. So you can lose money if it goes up too much. But remember, this is in the next 2 days. And it can actually go down, and it has to go all the way down to under $720 for you to actually lose any significant money. You'll be break even. You would have to. So even though we got the whole amount of $275 in this, with a traditional option that expires in 2 days or expires next week, you can lose 100% of this, 50% of this really quick. This is going to be less volatile, but it's still going to give me some nice size returns if Facebook does turn around and beat earnings. Trade this, while most of the retail traders are just buying the stock or buying calls right before earnings, and they get crushed even when the stock moves 5 or 10% because the implied volatility in the Thea in there is overpriced. So this calendar spread gives us a way to kind of capture some of that Thea and be an option seller, and we don't have to be as accurate or right on where we think that the stock is going to go.